Yesterday we started the day with the Federal Reserve in the US making an interest rate announcement. They didn't change rates, but they did say that they felt that the US recovery was on firmer footing, which would normally be really positive for shares. But clearly the global investors' minds are elsewhere at the moment, and they're looking at the situation in Japan and just wondering how bad it can get and what it means for global growth and for asset markets. Interestingly, looking at the Japanese share market yesterday, it actually posted some gains. Now this would typically be encouraging, but it comes after a pretty massive drop on the Japanese share market since the earthquake and the subsequent nuclear issues. The Japanese share market was down nearly a quarter at one stage, down 25%, and then it's recovered somewhat. So just a little bit of a market reaction, thinking perhaps the Japanese share market had been oversold, rather than a sign of things getting better in Japan. If anything, the situation there seems to be looking like it's getting more intense all the time. Beyond the Japanese situation, we had some housing data out, dwelling commencements in Australia, a little bit weaker than expected, but overall we expect construction in Australia to be fairly positive in the year ahead. And the US housing market looks like it's a long way from being fixed. In contrast, we had some inflation figures out in the States. Now, this is another thing that the Fed discussed. Inflation pressures look like they're starting to rise. That's really coming from energy and food prices, which is a story we're seeing around the world. Now, it's the same goes for Europe. And in Europe, we actually think it's going to cause the European Central Bank to start to lift interest rates quite a lot sooner than what we expected. In contrast, looking at the Fed's words yesterday, they look pretty committed to continuing with that asset purchase program. They're buying US Treasuries in an attempt to keep yields down. It looks like they're going to continue with that program until June. Now, all that news sounds pretty negative, so how's it affecting New Zealand at the moment? Well, firstly, we are seeing the New Zealand dollar coming down, and so's the Aussie dollar. It's back down below parity with the US dollar. And that's caused our cross rate to lift against the Aussie dollar. The Aussie dollar is underperforming at the moment. So we've lifted slightly on that cross, but we are taking a step down against the US dollar. And that's understandable when there's this massive mood of risk aversion. Now, one of the things we saw earlier in the week was commodity prices start to really soften as global investors got concerned about growth prospects and what the Japan situation was meaning. That's a normal sort of reaction. It came at the same time we saw that 8% drop in the global dairy trade auction, but we think it's too early to tie those two things in together. That auction has been quite volatile and prices have got very high lately, so it's pretty normal, we think, to see that sort of pullback, but it has come at a time when global markets look a little bit jittery. Overall, we're still fairly positive about the outlook for New Zealand's food exports, and at times like now, New Zealand looks pretty good as a safe place and a healthy place to be producing food.